Hi, I'm Dan Danford, and we're doing another episode of Money Made Easy for dadsdivorce.com. Following up a little bit, we've been talking about the nightly news and some of the things that you hear there and how you might interpret those for your own circumstance and condition. One of the things I want to talk a little bit about are indexes, or indices, as many people call them. These are actually just numerical numbers that we use to gauge things that are happening in the economy. Now, the most common is the Dow Jones Industrial Index. That's called Dow Jones, is what people call it. And every single day, every newspaper you read, every magazine talks about it, everything on TV, actually all day long on television, on CNBC, they track the Dow Jones Industrial so that you can see. Today, that number is somewhere around 11,500. It has been as high as 14,000, and in recent times, it's been as low as about 6,600. Now, here's the thing you need to understand about it. That number is arrived at by combining the prices of just 30 stocks. Okay, so every day they track the price of IBM, of Walt Disney, of Pfizer, of Walmart, and 26 other companies. And they just track the price of the shares of those stocks, and then they apply a multiplier to that to get that number, that 11,500 number. Now, the purpose of this Dow Jones Industrials has been around for 100 years, and basically the purpose of it is to give an idea of how those companies are doing in the economy. Okay? Their stock prices are supposed to reflect how the companies are doing, and then that index gives us kind of an aggregate or an average price for that entire group. So you can tell maybe from today until tomorrow, if it's 11,000 today and it's 11,500 tomorrow, what's that end up being? That's 5% or 4% on 11,000. You can see that the value, aggregate value of those 30 companies have gone up by 4 to 5%. Okay, so really nice. Okay, it just gives you a gauge. Now, if there's a limitation to the Dow Jones Industrials, it's that it's only 30 companies. So out of the thousands and thousands of companies that trade hands on the stock exchanges every day, that's just giving you this very narrow slice of what happened. That's why many professionals prefer the S&P 500. It's a similar kind of index created by Standard & Poor's, and the good thing about it is that it includes the prices of 500 companies, okay? So at any point in time during the day, you can look and see what are the prices of those 500 company stocks and apply that to the S&P 500, and it gives you an idea, a gauge of a broader group of stocks in the marketplace. Now, again, these are just giving you an idea of what's happening in the stock market. It is generally considered that what happens in the stock market has some bearing to the rest of our economy, and that's why people talk about this all the time. But of course, the question really is, how representative are those particular stocks? The S&P 500, more representative, the Dow Jones, less representative. Now it goes down from there. There's a Russell 2000 index, which gives you an idea of smaller stocks. There are international indexes that just look at stocks from across other parts of the world. The idea there is you can get some kind of gauge between what's going on in the United States and what's going on with businesses in other countries. In any case, the important thing to remember is those are just one indication, okay? And each one shares maybe a little bit different light on the circumstance. But none of them by themselves gives you the whole picture. Now, the other part that you need to think about are interest rates. We talk a lot about interest rates, and you see those numbers on television all the time. A common one is Treasury bill rates. Okay? Now, a Treasury bill or a Treasury note is actually a loan that you might make to the federal government. Okay, so let's just, in its simplest form, let's just say I'm going to loan the federal government $10,000 for the next 6 months. Okay, the rate today on that is probably less than 1%. But for the sake of discussion, let's just say 1%. That means at the end of the at the end of the 6 months, okay, I'm going to get $50 for having loaned them that money for that period of time. Okay? So that just gives you an idea of what interest rates are doing in the economy. Now, the federal government actually borrows money for longer periods of time, 5 years, 10 years, 20 years, and there's a different interest rate tied to each one of those borrowings. But overall, it gives you an idea of what's going on in the economy. In today's world, the interest rate is very, very low. That's because the business environment is pretty sluggish, and what the Federal Reserve is trying to do is to lower rates so that you and I will borrow more money, and that will stimulate the economy. Now, that same rule applies to businesses. With lower rates, businesses borrow more money, and so that's supposed to create more demand in the economy. Now, the important thing is not so much what's the relative rate, it's how does it affect you, okay? Because anything they talk about on the news, I mean, really when you get right down to it, what's important is how it will affect you and your circumstance. Now, the good news is that with interest rates, you know, the lower the rates are in the economy, the lower your rates are for the things that you borrow for. So if rates have dropped a whole bunch, you know, since 5 years ago when you bought your house, well, then you could probably go refinance your house today at a much lower rate and have much lower payments. Or conversely, you might keep the same payments but pay your house off much earlier because rates have dropped so much. If you're getting ready to buy a new car or a used car and you need to finance that, rates are lower today than they were several months or several years ago, so you may be able to do that as well. Okay? So when you hear them talking about it on the news, okay, the important thing is how does that affect me? What kind of opportunities does it create for me? Now, going back to the indices, as we talk about with the stock market, okay, how does that affect me? Well, lower stock prices are actually good for people who are accumulating investments. So for your 401k or money that you're periodically saving, when the Dow Jones or the S&P 500 is down, that's a good time to buy. Okay. For people who are, you know, in a retirement mode, or people who have a pool of money that they're going to need, you know, 6 months or a year and a half from now, then those lower rates are cautionary. Now it's time to maybe look at reducing your exposure to stocks and protecting yourself a little bit. Now, you know, these things are all relative. Some of you will be watching this several years after I actually create it. You know, the market may be a roaring bull. Those indices may be higher every day. That's okay. You just need to evaluate your personal circumstance based on that situation. My whole point today is to try to explain what an index is and what those indices mean, explain to you what interest rates mean, so that when you watch the news, you have a better idea of what it means to your family's circumstances. I hope I've helped accomplish that. As always, if you have questions or ideas, send them to us here at dadsdivorce.com. We're always glad to take a look at them. I'm Dan Danford for Money Made Easy. We'll see you again next week.